Summary of Technical Analysis for Dummies by Barbara Rockefeller. Introduction. Technical analysis is an exciting method used to evaluate and predict market trends by analyzing historical price movements and trading volumes. Unlike fundamental analysis, which focuses on a company's financial health, technical analysis thrives on market psychology and statistical patterns. Barbara Rockefeller's Technical Analysis for Dummies provides a beginner-friendly and engaging guide to mastering this approach for trading in various financial markets. Part 1. Understanding Technical Analysis. What is technical analysis? Technical analysis assumes that all market information is reflected in price movements and that history tends to repeat itself. Traders rely on charts, indicators, and price patterns to make insightful decisions that can turn their trading dreams into reality. Basic principles of technical analysis. 1. Price discounts everything. The market price reflects all known information, including news, earnings, and investor sentiment, making it a thrilling puzzle to decode. 2. Prices move in trends. Markets do not move randomly, they follow identifiable trends that traders can leverage for success. 3. History repeats itself. Human behavior in trading leads to fascinating, recurring patterns in price charts, offering golden opportunities for those who can spot them. Part 2. Charts and patterns. Types of charts. 1. Line charts, the simplest yet powerful form, showing closing prices over time to help traders identify trends effortlessly. 2. Bar charts, a dynamic display of opening, high, low, and closing prices, OHLC, that gives deeper insights. 3. Candlestick charts, a trader's best friend, visually capturing price movements and market sentiment in an engaging way. Key chart patterns. 1. Trends, uptrends, downtrends, and sideways trends define the thrilling dance of market direction. 2. Support and resistance levels. These key areas act as invisible forces that prices tend to bounce off, creating incredible trading opportunities. 3. Reversal patterns. Patterns like head and shoulders and double tops signal trend reversals, giving traders an adrenaline rush as they anticipate big market moves. 4. Continuation patterns. Flags, pennants, and triangles suggest trends will continue, keeping traders on the edge of their seats. Part 3. Technical indicators and oscillators. Moving averages. 1. Simple moving average, SMA, a timeless tool that smooths out price movements, revealing trends clearly. 2. Exponential moving average, EMA, gives more weight to recent prices, making it a sharper, more responsive indicator. Momentum indicators. 1. Relative Strength Index, RSI, a thrilling measure of overbought and oversold conditions, helping traders catch ideal entry points. 2. Moving Average Convergence Divergence, MACD, shows trend strength and momentum shifts, making it an exhilarating tool for spotting opportunities. Volume-based indicators. 1. On balance volume, OBV, tracks cumulative buying and selling pressure, revealing the real market force behind price moves. 2. Accumulation/distribution line, helps identify divergences between price and volume, uncovering hidden signals. Part 4. Trading strategies using technical analysis. Trend following strategy. 1. Buy when an uptrend is confirmed, higher highs, higher lows, and ride the wave to success. 2. Use moving averages to identify and confirm trends, feeling the pulse of the market. Mean reversion strategy. 1. Prices tend to revert to their historical mean over time, presenting exciting opportunities for quick gains. 2. Use Bollinger Bands and RSI to identify overbought or oversold conditions and jump in at the perfect moment. Breakout trading. 1. Identify key support/resistance levels, waiting for that thrilling breakout. 2. Enter trades when price breaks out of a range with high volume, seizing the moment of momentum. Risk management in trading. 1. Stop-loss orders, the safety net that protects against significant losses, giving traders peace of mind. 2. Position sizing, limits risk per trade based on account size, ensuring sustainability in the trading journey. 3. Risk-reward ratio, ensures potential reward outweighs potential risk, keeping traders disciplined and focused. Part 5. Common pitfalls and psychological aspects avoiding common mistakes. 1. Overtrading due to emotional reactions, a mistake that can turn an exciting venture into a stressful one. 2. Ignoring risk management principles, which separate successful traders from the rest. 3. Relying on a single indicator instead of combining multiple tools, missing out on a comprehensive market picture. Market psychology and behavioral biases. 1. Fear and greed. These powerful emotions drive market cycles and trader decisions, often leading to unexpected twists. 2. Confirmation bias. Traders tend to favor information that supports their pre-existing views, sometimes blinding them to the bigger picture. 3. Herd mentality. Following the crowd can lead to poor decision-making, making it crucial to develop an independent trading mindset. Conclusion: technical analysis is an exhilarating tool for traders looking to make data-driven decisions in financial markets. By mastering price patterns, indicators, and risk management techniques, traders can significantly improve their chances of success. However, no system is foolproof. Combining technical analysis with solid trading discipline is the ultimate key to long-term profitability. This book serves as an invaluable resource for beginners, offering practical knowledge and strategies to navigate the financial markets with confidence. Whether you're trading stocks, forex, or cryptocurrencies, mastering technical analysis can provide a thrilling and rewarding competitive edge.